Hi, everybody. Welcome. This is Seth with the Middle Class Investor. Thanks for visiting this week. We've got our normal S&P 500 chart up here, and it was another up week. Zoom in here a little bit so we can look at it for a second. We've been, we had this sell-off a couple months ago, came down here into October. And then ever since then, it's been up pretty strong, up back to the top of this trend line. Now you can see the last time we got to this trend line, we spent 1, 2, 3, 4, 5, 6, 7, 8 weeks there. And then we went down and we spent 1, 2, 3, 4, 5 weeks there. So, we could spend some time here before the market makes another push up. We could get a little something like this and then a push up higher. To me, just the whole narrowing of the market makes it look long in the tooth, but that's a prediction, and predictions are kind of dangerous business in the stock market. So I wouldn't give up on this pattern just yet. Although now with QE gone and some of these other things that the Fed was doing, who knows how this is going to play out? Who knows how real any of our economy is? With the money printing and whatnot, it's hard to say, how much of it's real and how much of it's just flowing into financial engineering. One of the things that's happened in this market, and nobody really knows what the effect is the whole low interest rate. Hey, we can't find anywhere to invest in our business, so let's just buy back our stock. And one of the companies that's been doing quite a bit of that. Let me put a 2-year chart up here. Here's a 2-year daily chart, so you can see that this was a pretty high velocity move up, but it's really kind of slowed down the last couple of weeks, and kind of fell off here but bounced back up. You don't know. Never know. It could bounce back down into this area, maybe even a little lower before it resumes the uptrend. But getting back to buying stock with cheap interest rates, IBM's been doing that now for a couple of years, and essentially what they're saying by doing that, by buying back their stock, is they can't find anywhere else to invest to grow their business. And you can see that investors have taken IBM down from $210 down to $163, which is pretty significant. IBM is a bellwether company. So, and this is not just IBM. This has been happening with a bunch of major companies, a bunch of blue chip type companies. These companies get to borrow at super low rates, especially with interest rates low like they are, and the fact that so many retired people need income. It really drives that high yield market, the high yield bond market. And so IBM just felt like it's beneficial to borrow money and buy back their stock. Of course, they bought back their stock, when it was up here around $200. Really, they've been buying it all along through here. But isn't it interesting that, the best place on this chart to be buying back their stock would be here at $163. And if you go back 10 years, if you go back to 09, it would have been good for them to buy their stock around the $70 or $80 area. So, historically, excuse me, companies are, even though you have insiders there, they typically are doing the wrong thing at the wrong time when they buy back their stock. So usually, this kind of signals at least a rest in the bull market. So usually. Let's go back to a weekly chart and let's look at interest rate market. That's the one I think is the big not only unknown, but also it's the big tell. Okay, so if the market sells off, you can see interest rates maybe falling as, risky money comes out of risk and flows into perceived safety of the US 10-year Treasury. Or it could go the other way. You could see yields really spike. And I think if you see yields get above this 2.7 area, you're going to start to see a lot of fear in the marketplace. And so really which one of those scenarios play out, I don't really know. Nobody knows. But we've been operating under the assumption that this was the low back here in 2000, when was this? July of 2013. And if this was the low, and this was the first move off the low, and this is the first correction after the first move, you could see a pretty significant move here in interest rates, well above this 3.1 area. So it's kind of a chicken or the egg thing. Nobody really knows what's going to happen first. We've been looking at the euro. We've been expecting the euro to come down to this line. It actually went through this line. And I would say if it doesn't get back above this line fairly quickly, you could see the euro make another significant move down from here. Let's see what the next area. I guess the next box would be this box right in here. So, just it doesn't look like the euro's through going down. So. We'll just have to watch it and see what happens. But there's been a lot of talk about what the ECB can do for the European economy. And I don't know, the ECB, the European Central Bank, talks about all these things they can do. But really, I'm not so sure there's a whole lot they can do, because you've got all these sovereign nations that make up this common currency. And, somebody's not going to be happy, right? Because somebody's going to look at destruction of the currency as, benefiting maybe one nation and harming the other nation. So it's hard to say that, it's hard to see how the European Central Bank, I think the expectation is they're going to do something to debase the currency. That's why the euro is falling. And it looks like it wants to continue to fall, but I think the reality of the situation is that there's not a whole lot the ECB can do about having its own QE type business or QE type program like the US did. I'm just not sure how possible that is. Looking at Germany, we were watching this trend line. It pulled back, bounced off that trend line. I think you'd have to assume that Germany is going to make a new high up in here. So if you're interested in investing in Germany, you could buy the EWG. Japan, I don't know. Japan's a mess. I don't know that I'd mess with Japan a whole lot. Although it does look like to me that Japan is going to make a new high. That's the EWJ above this level right here. So let's go ahead and draw that line here. It looks like to me that there it is. That the Japanese market's probably going to make a new high above this. And then who knows what happens. Maybe it's a hard sell-off after that. The United Kingdom is looking a lot weaker than it did just a couple of weeks ago. Maybe this is the top in the United Kingdom, and we've got a rollover, and we're testing the underside of this trend line, this lower trend line. I would say this is going to be a key area. If it gets up into this area, look for if it breaks through to make a new high. If it rolls over, then you could have a trend change in the UK. It's all gonna depend on what happens at this trend line, though. So we'll watch that trend line very closely. Um, one of the charts I wanted to put up. This is the global Dow, also known as the G Dow. And what's interesting about the G Dow is even though the Dow Industrial in the U.S. is making new highs, the G Dow is really laboring here, and to me, almost looks like it wants to roll over. We've talked about the way markets top before, and you can see here you've got a high, and then you've got a low, and then you've got looks like a lower high, and then a lower low. So if the G Dow breaks below maybe this level right in here, then you could have this next move down could be significant, and it could spark some selling in global markets. So I'd say, a break below this 2550 area on the G Dow is probably going to beget some more selling. The VIX is interesting this week because it really trashed our little trend line that we had here. This one got trashed a while back, but this one was kind of holding in there. We had a close below here, and then this closed right on it. We had breaches, all along here, but then last week, it opened up and then sold off and just crushed this trend line. So, the VIX, I think, I've heard other people comment about the VIX. I don't think anybody's experienced this kind of volatility in the VIX ever. So most people are kind of shocked. You could get something like this next week where you get an open and a close inside the range, and then if the week after that you got something that looked like this, you could see the VIX maybe moving back up. This is called a bullish harami. So when you get a big bar like this into a downtrend, and then you get a range inside that bar, and then you get a close above the bar that's inside the range, that usually marks, an uptrend, a resumption of trend there. So we'll look, maybe that happens, maybe it doesn't, maybe you just get, maybe we just get something lower, right? We get something that goes down here even lower. I think the odds of that are pretty slim. Really following the markets and everything is I don't talk a lot about probability, but a lot of it is probability. Trend is usually more probable than trend reversal. Let's come over here to the Dow Jones just for a second, because we haven't looked at it anyway, so we'll go ahead and take a look at it. But if you see here, let me zoom in right in here, and I want to cover kind of this probability stuff with you just a little bit, because I think it's important. But you can see here we had a pullback, okay, into a low, and the low is higher than this low right here, which you had a similar hammer back here. But once the selling was over with and the market crossed above the high of this low day or this low week, you can see that the trend really has been intact, right? And by the same token, if you come over here to where selling is, you can see here we had a high right here, okay? And then the market pulled back, and here's the low of this high week, okay? So here's the low. Once it crossed past that low, you can see that a lot of selling took place, right? The same analysis can be done on a daily chart. And what tends to happen is when the trend changes in any time scale, it doesn't matter, weekly, daily, on an hourly chart, whatever, the trend tends to go in that direction until it starts going in another direction. But what's interesting, and the way it's helpful to think about this, is you can just let this selling take place, for example, and then enter your position right here. And then you get all this upside. Now, when you just mark the high week each time, this is the high week. So what we're looking for is we're looking for a close, say, below this area. So if next week the candle looks like, like that, then likely what's going to happen is this is going to continue to fall until you get, another one of these. Or you could actually get, whoops, let me get rid of that. Let's say you got something that looked like, let's say we had this downtrend and it looked like this, and then we got one of these. Okay, remember I just talked about that, a bullish harami, and then you had one of those. And so what I'm saying is from right here, from this point right here, you've got a new trend, and that new trend is likely to go like this. So you can think about how you're managing your account. For example, if you had a move like this, you don't panic and get out right here, right? You wait and you see if you get a bounce and a higher high. So in this case we got a higher high. The high was up here, right? So the uptrend is intact. We had a pullback to a higher low. This low was higher than this low, and we got a break. We let the selling take place. Then we got a break above this area. We entered, and we've stayed in, and now we've got a higher high. So you could get a pullback. It could be a higher low, right? This low would be higher than this low, or it could be a lower low. But the probability is that it's a higher low. Okay, the probability is that this does not pull back as far as this. And so you just need to learn how to think in terms of these probabilities, and then don't panic. Okay, don't overreact to something that looks scary. If you look at one of the problems you run into is if you look at your account balance, and this is something that I've done, and it's harmful to your success rate. So I don't want to get into that too much because I know that most of you out there are not traders. You're investors. You're saving your long-term money, and you're in a 401k or an IRA. What I'd rather focus on is just something like the 10-year interest rate market, and watch it closely and watch to see what happens here. Either this is going to drive a sell-off in the equity market, or the equity market is going to have a sell-off, and the Treasury market's going to respond. I mean, that's really more useful to you because it tells you, what you should be invested in. So, for example, if we break above this line or this line, let's say we get up above this 272.5 area. In my estimation, we're probably moving much higher, and you want to be out of anything that's interest rate bearing. So if you get above this high right here, if the 10-year yield gets above this area right here, which is about 2.7%, then likely this is happening. And if this is happening, any bonds you have in your portfolio are going to lose a ton of money. So the reason I keep calling attention to this is because, if you're in bonds, I suppose you could stay in bonds. It's not really costing you at this point to be in bonds. But if you get up above this area right here, this could be a monster move, and it can happen actually fairly quickly. So we want to be watching it closely. Let me get out of this. I want to look at. I want to switch over to the other chart. Well, let's look at the DAX first. This is for those of you who don't know, this is another software program I use. And it looks like the DAX, had a pullback. This DP stands for decision point. And typically, and I've showed you all this before, but when you have a swing high or a swing low, the market tends to move from swing to swing. So for example, if I take a DP off of this low right here, what you'll see is that it puts a DP right where the market went to, and vice versa. This is the most recent swing high before this down move. So if I click on the DP here and put it right there, then that gives you this DP right here. So the market, the DAX is likely moving into this 10,000, 300 area, and then it's going to have to make a decision. Does it continue on up through it, or does it start to sell off and then go down? Now, if it goes down, where's it likely to go? Well, it's likely to go to the DP off of that low, so down here into this 8,077 area. So that's kind of how the DPs work. That's not my invention anyway. That's and I don't know if it's invention might be not the wrong word, but Steve Griffiths with MT Predictor, he's the one that developed this DP tool. And basically the way you use it is you look at the most recent swing high. So here what you gotta try to remember is that you don't know any future right here, right? You don't know anything here. So what you do is you look at the most recent high once you see the market roll over, and you put a DP on, okay, and then it puts it out there for you in the future, so you know where the market might go to. Now that you have a new swing, we have a new swing here, and it is the most recent swing low, okay. And if you'll notice, this low, if I take a DP off this low, it didn't quite make it down to that one. But if you take a DP off this low, it's the same DP. That's unusual, actually. It did make it down here. So a lot of times these DPs, you click on it here, it doesn't quite get to it, so it makes a move up and then a move down and gets to it. But they're good. It's a good way to think about the market, because the market doesn't just go straight up or straight down. It goes from support to resistance, resistance to support. And that's why when I talk about higher lows and lower highs and things like that, really what we're talking about is we're talking about every low on the chart is support and every high on the chart is resistance. But it doesn't just go, like right here, it doesn't just go straight to this level of support. You got a level of support here, you have a little one here. So you have to kind of take the market, step by step. That's why if you're a really long-term investor, what you could do is you could look at longer-term charts. In this case, it's a monthly chart. So you can see the pivots here. There's a pivot here. This is a pretty strong pivot. So you could say, okay, if I got below this level right here, then maybe I need to go ahead and get out, because it's going lower. You don't know how much lower. You just know that it's maybe going to here. Or maybe, you could also take the opposite view. You can say, well, I got support here, but then you see it broke support, and so then maybe that's when you leave. But if you really look at these swings, you'll see that the market just moves from pivot to pivot. And sometimes it moves dramatically and might go through those pivots, but a lot of times it hits those areas and shows those levels of support. So I would say more than 50% of the time those areas of support are important, and so they're worth looking at. But nothing works 100% of the time, so you can't say that those support areas are 100% effective. Let's look at gold. This was the bull move in gold. This is the bear market, the most recent bear market. This was that consolidation triangle that we were looking at. We broke out of it and then quickly got back in it, and we've just been bouncing around this lower line. So it's hard to say what gold's wanting to do here. I think it got pretty strong support at this area, but it hadn't actually come down to that area. So remember what I just said. It could go up, not quite get to that area, go a little higher, and then come down into the area. So You just have to watch gold, see what happens. The dollar, you're starting to hear more and more people talk about the dollar. The reason the dollar is going up is, or the reason gold is going down is because the dollar is going up. Just visually, the area of support I have on the dollar is this 92 area. So you can see that the dollar's got some more room to go up, which means gold might have some more room to go down. I don't know. This is just what I see on the chart. Somebody else may see something totally different. So we'll just have to see how that plays out. But I can easily see the dollar going to 92, 93, and I can see, I mean, part of me says that gold has reached a low for the time being, but then the other part of me says, wow, this break, normally when you have a triangle like this, a break out of the triangle usually results in a larger move than that. So usually you can kind of take, I don't know, kind of the, say for right here, say 1215 to 1380, take that difference and add it on to the triangle. So that would bring you down here, probably even below the box I've got here. So I'm not sure gold's through going down. We'll just have to play it by ear. Certainly you could, if you're a trader, you could take a trade underneath the market and then get out if it rolls back over. I think it's fairly low risk right here for some sort of bounce. But and I think the better probability is that it might go a little lower, and the only reason I say that is because the dollar to me is more clear. When you go back and look at the dollar looks like it wants to go up to this area right in here. So for what that's worth, hopefully that helps. I wish there was more going on in the market, so I could help you make a decision. Right now there's no decisions to make, so it's just me yakking and some of you listening, some of you not listening. If you think this is important and you think it helps, certainly share it with your friends and family. Again, you can follow me at InvestorClass on Twitter, and you can watch the videos on YouTube at Middle Class Investor. If anybody has any questions or comments or would like to bring up anything in the weekly YouTube video, please just make a comment on the YouTube video, and I will try to incorporate any ideas, any comments, any discussions anybody wants to have here on the show. Okay? Thanks a lot, everybody, for tuning in, and we will see you next week. Take care. Bye-bye.